Three stocks to avoid. October 2025. Number 1, OpenDoor. OpenDoor stock is up more than 1000% since July, but this incredible move seems to be driven more by speculation than fundamentals. The move started when fund manager Eric Jackson started tweeting about the company, calling it a potential 100 bagger. This led to renewed investor attention and a retail-driven short squeeze. Then, former Shopify director Kaz Nejatian joined the company as CEO, further cementing optimism. The problem, however, is that OpenDoor's iBuying real estate business is inherently precarious. Gross profit margins are thin at only 8%, and the company has never reported a full year of profits. Even in an optimistic scenario, the stock price looks unjustified. For example, let's say OpenDoor hits Eric Jackson's revenue target of $12 billion by 2029 and manages a net income margin of 4%. That would result in $480 million of net income in 4 years' time, and a 20 times multiple would then take the company's value to about $9.6 billion. The expected annualized return in that scenario is less than 7%, and it doesn't include significant amounts of future share dilution or housing market risk. Number 2, IonQ. IonQ builds trapped ion quantum computers and delivers access to them via the cloud. Unlike classical computers that use bits representing zeros and ones, quantum computer qubits allow the exploration of many more possibilities all at once, thereby increasing total computing power. It's clearly a promising technology, and IonQ CEO Niccolo de Masi said that the company's qubits will wipe the floor of any other supercomputer by 2027. That includes machines built with Nvidia's top GPUs. But there's a lot of hyperbole in that statement, and IonQ has a long way to go. Over the last 12 months, the company made just $52 million in sales, while losing $464 million in net income. With an enterprise value now over $18 billion, any setback or change in investor sentiment could easily trigger a significant share price decline. Number 3, Bitmine Immersion Technologies, ticker symbol BMNR. Bitmine has transformed from a crypto mining business into one of the world's largest Ethereum treasury companies. The strategy involves raising capital by selling shares and then using that capital to buy Ethereum. As the underlying technology for blockchain and smart contracts, Ethereum is seen as the fuel that powers the crypto space, and new political legislation is speeding up its adoption. Meanwhile, the crypto treasury strategy, pioneered by Michael Saylor's MicroStrategy, has proven to be a hit among investors. However, more firms are now getting into the crypto treasury trade, which suggests the idea is getting crowded. Investors now have several treasury companies to choose from, and Bitmine's strategy carries clear risk. Raising capital via share sales aggressively dilutes shareholders, which only pays off if Ethereum increases in value. Ethereum may be a promising technology, but it's still a highly volatile asset, and its continued price rise is not guaranteed. That means this stock has huge potential downside if Ethereum drops in value. So those are 3 stocks to avoid, and I hold no position in any of these companies. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.